We are here on Urban View, Channel 126. We're talking Power as it Becomes Action. Sina Ghaznavi is with us, of course, the host of producer of Fraudsters. And you can follow him at Sina Now on the Twitters. Joining me, rolling down this Urban View River. You can listen to him as I do, driving around on Saturdays, 9 a.m. Eastern, the Lou Hutt Show. Let me welcome the great Lou Hutt is here. Yay.
Hey, Karen, it's always great to be, listen, anytime I get a chance to come on your show and talk with you about real life, it's a pleasure. It's an honor.
Listen, the work you do, I was telling you off mic, is life affirming. And I love that you care so deeply, because I've been to places and it's not like you're an accountant. You're a person that manages money. You also you're a lawyer, so you understand the tax laws. You know, so like you come to a Lou Hutt situation, you're going to get the full panoply of like what it is we need to know about our money, but you care about us, like the individual. We were just talking about that with doctors, not just asking, what do you need?
Hey, Karen, you just hit the nail on the head. In any professional business, even a personal relationship, if the care element is absent, it just ain't right. You know, and I say that because professionally, a lot of times, I say it's coaching. You can look ahead. Someone will ask you a question that may relate to an immediate decision that they have to make. But if you care, you say, let's take this thing a step further, because this might be the right answer today, but 6 months from now, you may need to make an adjustment. And here's what you need to start thinking about. See, and again, that's just information and guidance that somebody didn't ask you, but if you really care about them, you'll offer that.
Yeah.
Big difference.
Everyone's about that bottom line. All right, it's February. It's January. I said it's February.
Almost.
It's January 26th, and I already know what I'm gonna owe in April, because I don't wait until April. I'm not gonna be stressed out.
Smart lady.
No, and I do my estimated. This year I did all my estimated taxes. Boom, you're not going to hit me with no surprises in April. Nope, I already paid y'all. Stop playing with me. But for most of us, we wait until the last minute because most of us expect a refund. So we either file late or don't file because they owe me money anyway, so I'm not going to do it. It's too much of a hassle. I don't want to go to H&R, whoever.
Yes.
What are some of the mistakes people make in waiting too late to get their tax information together?
Well, I'm going to start with the basics. What we know is we live in a world today where identity theft is ubiquitous. It just happens globally. The first tax return that is received by the IRS is processed. If it's not your return, when you do process and file your return, guess what? There will be a presumption that you're the bad guy, which means it's going to take 3 to 6 months to resolve, because now they've got to do a thorough vetting to determine if you really are Karen Hunter or an impersonator. So that's one very important reason to start early. First come, first serve. Now, second thing to always think about, and Karen, you and I have talked about this many times, it's your money. So if you are due a refund, and let's say you got a credit card that's you're paying 16 to 18% interest, wouldn't it make sense to get that refund as early as you can, make a payment on that high interest debt and reduce your costs? Oh, heck yeah. The other thing is, even if you owe, Karen, by doing it early, we can assess your debt payment options. We've got time to be strategic about how we deal with it. So a lot of those are very important considerations when it comes to the timing of when you file.
Lou, when you're saying that someone would file a tax return before you, is that they're trying to get the refund delivered to them personally? Is that the idea there?
Yes, and sometimes, Sina, most of the time, these are fictitious tax returns.
Yeah.
So they're bogus deductions, and they're filed, and the fraudsters receive, in essence, Karen Hunter's refund. And when Karen Hunter files her tax return March 15th, she's going on several months. I wonder why I haven't got my money. And all of a sudden, about in June 1st, you get a letter from the service saying, we need you to verify your identity. And then the process starts.
What a nightmare.
Oh,
I've
terrible.
never heard about that, but that sounds so obvious. And it definitely is a motivating factor to get your taxes done soon. Oh my God.
You know, Karen mentioned getting a refund. And let me chat about that just for a second, because the IRS is warning that tax refunds will be smaller this year than in the past. Several reasons, particularly if you have children. One of the things that we know was very prevalent, particularly in 2021, is that folks were receiving a child tax credit for a youngster under the age of 6 for up to $3,600. Now, notice I say credit, not deduction. Credit is a dollar for dollar reduction in tax. So that's a big thing. $3,600. If your child was between 6 and 17, it was $3,000. So you can imagine a household that receives, call it, say, 2 children. They get anywhere from $6,000 to $7,200. Well, in 2022, that was modified because that big tax credit was a temporary measure. Now we're down to $2,000.
What?
$2,000 from $3,600 all the way down to $2,000. So that's one consideration.
Oh, look, Karen's just sipping her tea happily, not worrying about child tax credit. This is what everyone told me. Have kids. The government will pay you to have the kids.
Yeah.
That's what you should do.
But you should have started before the pandemic. Now,
You should have had 3 before the pandemic.
Nobody's perfect, Lou. Nobody's
Absolutely.
perfect. We're doing what I can over here.
And a similar one, since we're talking about parents with children, is the Child Independent Care Credit. Now, you understand, it's a child tax credit, and there's this so-called dependent care credit. Now, dependent care credit is primarily for working families, working parents. During 2021, you had 1 child, you could take up to 50% of $4,000, and that equals your credit. So if you all can follow me on this one, we're talking about you got credits for child tax credit, you got a credit for child independent care credit. Folks were rolling in 2021, but now 2022 comes. Not quite as lucrative. As a matter of fact, the credit on your expenses is defined by a rate of 35% up to a maximum of $3,000 per child. That's quite different. In 2021, it's 50%, up to $4,000 per child. So the IRS has got a point when they're trying to warn folks, don't, take for granted you're going to receive the same refund that you received in the prior year. But there is some good news. And the good news is circling around clean energy. Oh, yeah, clean energy. As a matter of fact, there is a clean vehicle credit up to $7,500. But you got to purchase the right vehicle. And the manufacturer has to assemble 40% of that vehicle in the United States. But let's assume that all that is met. Then what you're potentially looking at is $7,500 to purchase an electric powered vehicle. So some, Karen and Sina, part of being strategic about your taxes now is to read the tea leaves. Where is Congress headed? What are the kind of changes that they are promoting? Now we know, and I'll get to retirement in a second, but we know clean energy is a big one. So I'm saying to people, listen, if you're looking to get your biggest bang for your buck and you need transportation, this is the time to really give serious thought to purchase an electric vehicle. And before anybody gets, say, oh, I heard Lou on Karen show say that I could get $7,500. Well, if you are married filing jointly and your income is over $150,000, you don't qualify.
What?
That's
Wait,
right.
what if you're single?
I thought this was
what is there?
No
income?
one cares. No, wait, hold on.
No, wait. Be first.
75,000 single.
Wait.
If
So
it's
what's
over
the point?
75,000,
You're out. There's no chance for you.
Okay.
I know. And see, I was wondering why she even asked the question.
I want a refund. All right, go ahead.
But it's fascinating when you think about it. And as you all know, what was reported, maybe a week, 2 ago, Tesla dropped the prices of some of its vehicles.
Yeah.
They want their vehicles to qualify because a passenger vehicle has to be priced no more than $55,000. Oh yeah, you got to read the fine print, Cena, before you jump into this.
I mean, I'm out. None of these things are going to help me. I already bought a Tesla like an idiot. And so I bought it before all this stuff. I missed even the California credit. I missed that because we were moving and I didn't get it in the 30 days. California is supposed to be this like liberal paradise. I'm getting crushed left and right over here. I mean, I tell you, it's rough out here. I thought, and then I didn't know about the child tax credit going away or getting reduced. This is tough.
So, go ahead, Karen.
No, I'm asking personal questions. Lou Hutt is here. The number here is 866-801-8255.
Karen's bringing out her QuickBooks right now.
I am. My NetSuite by Oracle. So Lou, you're told in America that rich people don't pay taxes. Right. Yeah. If you're in the 10% or the 1%, there's milk and honey for you.
Yes.
What am I doing wrong? No. I pay so much taxes. I was like, I paid more than freaking Elon Musk and Warren Buffett and Bezos combined last year. And I just need to understand how much is it to be rich enough to not pay taxes? That's what I want to know.
Well, I think
what's that number?
You and literally hundreds of thousands of people are wondering the same thing. And the reality is, as a percentage of income, the affluent do pay less. Now, the other side of the argument is they would say, wait a minute, people that make over $200,000-$300,000, they're the ones that are paying income tax. But what I say to folks is, when you talk about folks, and obviously this is not you or Cena, but if you talk about folks that are low to moderate income, you also have to take into account the cost of payroll taxes. See, because the payroll taxes is a big hit.
Huge.
If you are working with an employer, whether you know it or not, they're withholding 7.5%. If you're self-employed, and this is the killer, you pay 7.5% plus 7.5%. In essence, you double up. And so Karen mentioned at the beginning of the show about paying estimated tax payments quarterly. It is imperative because a self-employed person doesn't have an intermediary. They don't have an employer that is withholding these employment taxes. So a self-employed person, a gig worker, small business person, part-time business, they look at their bottom line and say, oh man, this is great. I made $10,000 in 2022. And the question I posed to them, what is that after tax? Because let's just face it, my 15% means right off the bat on the $10,000, you're going to pay $1,500 with employment tax. We haven't added on, the California state income tax. We haven't even added on the federal income tax. So the bottom line is, as a self-employed person, you can easily become taxed overall at 35 to 40%.
Yeah. Correct.
And if you're not paying that as you go, oh man, it's a shock when in March or April, your advisor says, yeah, this is the number. So again, what you said, Karen, is right on the money. Today, you have to be proactive and strategic to minimize your taxes.
So
one
Lou,
thing-
you talked about, I'm sorry, Cena, I just have to, this is
Yeah.
adjacent to the car, the Tesla that you bought that you won't be able to write off because you make too much money and it's too late. But what about solar? You know, those of us, you know,
Oh,
I'm thinking about adding solar to my home, you know, because I don't trust this government and I want to be off the grid, but that's not why. But it is.
brilliant, Karen, because that's where the action is for the average household. It's with clean energy. Two credits that are going to be, oh, well, one of them was on the books even for 2022. And I describe it as home improvement energy steps. So for example, if you install a water heater, you install doors, windows, things, items that improve the energy efficiency of your house, that in 2022 is $500. In 2023, it's $1,200. So I tell folks, don't get upset if you missed it in 2022, because in 2023 it's going to be $1,200. Now, Karen, you brought up the other category, which is energy saving equipment. Oh yes, the solar panel, it's the geothermal energy. It's all of those pieces of equipment that can make a significant reduction in your utilization of energy. They qualify for a 30% tax credit. You spend $30,000, you get a credit of $9,000. So I like your thinking, because you're sort of saying, how can this be a win-win situation? I reduce my taxes, and at the same time, I do something to appreciate the value in my home. I love solar concept. So you're right on the money. That's the good news. There's another piece of good news I should share with you.
I love good news.
Yeah.
Right.
Retirement. Now, you know, I always say, listen, I just look at this as, I don't look at it as, this is someday we're going to use this money when we're just sitting in a rocking chair. No, I think it's some money that you're going to use in the fourth quarter of your life when you just want to chill and you want to decide what you want to do, but you want to maintain the lifestyle that you have become accustomed to. Now, the government will reward you. They'll incentivize you. So what they've done this year is they have increased the amount that you can put into a 401k. Oh man, this is great stuff, Karen.
This is this year. I'm writing it. Go ahead.
Okay. 2022 max was $20,500. 2023 is going to be $22,500. Let me add on another component. In the 401k arena, if you're 50 and older and you want to catch up, you say, I've really been behind. I got a slow start. Well, you can put in an additional $6,500. That's what you could have done for 2022. In 2023, it gets sweeter. You can put in up to $7,500 if you're 50 and older. So that means in 2023, you essentially can put in up to $30,000. Why do we like 401ks and IRAs? We like it because it offers deferred income growth. Deferred income growth. You don't have to settle up on the tax piece until years in the future that you begin to withdraw the money. Now, I know.
And is it a dollar for dollar? Is it a dollar for dollar write-off?
No.
What is a dollar for dollar write-off? Is it because I have as a self-employed person with an IRA?
Yes.
There's a dollar for dollar write-off in investing in your retirement in one of these things that I have.
Yes.
Which
what
one is
it? What it will do is it will give you the equivalent of a deduction. Okay. Now, the reason I back off on the dollar for dollar reduction is because that only applies to credits, tax credits. What you put in terms of your IRA or you put into your 401k, 401ks we know are the equivalent of deductions, but but IRAs depend. And I'm going to spare you some of the detail, but essentially what the IRAs operate on this premise. If you have a retirement account that's offered to you at work, then we're only going to allow you to claim a deduction for your contribution if your income is below certain thresholds. So what I encourage people to do is fully exhaust investment in your 401k before you think about an IRA. On the other hand, if you work for an employer and or you're self-employed and you don't have access to a 401k, then utilize the IRA. It's a good process. It's a good way to store. Again, it offers tax-deferred growth. Now, key point. At some point, the rules say you have to start withdrawing that money and it will be subject to tax. Good news is that age limit has been raised from 72 to 73. So the bottom line is folks that are getting closer to that stage where they're going to be forced to withdraw money. And by the way, that's called required minimum distributions. As you get closer to that, you can have some comfort in saying, well, at least I don't have to withdraw the money. I can leave it in that account, let it grow, continue to increase in terms of value. And when I get to be 73, at that point, yeah, I'll take it. Now, the option, of course, and some people listen, they say, well, Lou, I don't have to take required minimum distributions if I'm investing in a Roth 401k. And I say, you're right. Because really, Sina and Karen, really what this comes down to is every individual, every household has to decide, do we pay taxes now? Which is what would happen if you invest and contribute to a Roth 401k. Or do we pay taxes later when I reach 72? But by the way, you can dip into any of these accounts once you pass the age of 59 and a half. But assuming that you wait, that allows that, let's call it almost an investment account, to grow and to build value. That's a long-winded answer, but I'm just.
No, you're thorough. This is the thing, Lou Hutt, and those of you who are part of his team on Saturdays, and you tune in and you call in, and his personal team. The other thing I love about Lou Hutt is he has passed the baton. He has groomed his children to take his business over whenever he feels like retiring, which doesn't seem anytime soon. But you have a whole team of you've duplicated yourself multiple times. You didn't just do it one time. You got like 3 Hutts